Well, it's been a choppy week for tech stocks, and that often gives rise to the question, are we in or are we approaching an AI bubble? Our next guest says bubble talk is overdone, but indeed the market could be due for a correction. Joining us now, Nancy Curtin, Chief Investment Officer at Alton Tiedemann Global, which manages more than $70 billion in assets. Nancy, it's great to see you. It is
lovely to see you as well.
It's been a really interesting week. We saw a pretty sharp sell-off earlier in the week, and then we've seen this choppiness and this sort of uneasiness come to the market, particularly around tech stocks. What do you make of that? What does it reflect, and could we see more of it?
Well, look, we think the market is overdue a correction, and therefore, this week, next week, we could easily see the market go down another 2 or 3%, get to that 50-day moving average, and perhaps even below. Our sense is that going into the end of the year, the market will continue to do well. Remember, seasonally, November, December tends to be good for the markets, and there's a lot of cash on the sideline, a lot of strategists that have missed this rally. So, but we do think a correction is overdue. Trees don't grow to the skies, etc. We should talk a little bit about the bubble talk on Gen AI. It's our view that this is not a bubble in the classic sense. Sure, there's a lot of stocks that may be slightly in bubble territory, valuations that are extreme. But I think one thing investors need to keep in mind is that innovation bull markets, and this is definitely one of them, tend to last longer and valuations go higher than people expect. Why is that the case? Because an innovation-driven bull market, unlike a cyclical or liquidity or recovery from recession type of bull market, fundamentally, you are adding earnings and productivity in infrastructure investment to the economy. And that's very powerful. It doesn't mean it doesn't go through fits and starts and have volatility, but these innovation-driven bull markets, as I said, tend to have further upside than investors expect. And that's our sense here. Ultimately, all bull markets are killed by the Fed, but they seem to be in an easy mode at the moment.
Well, and Nancy, I think there's the question of whether it's a bubble, and then there's also the related but separate question of what kind of return on investment all of this investment and this innovation cycle is going, what are the fruits of all of this? And it feels like that is a legitimate question, but to your point, maybe not one that is really going to come home for the next year, 2 years, who knows? I mean, how are you thinking about that question?
Well, when we look at the hyperscalers, the earnings were announced last week. As far as I could see, they all beat on the upside, both revenue and earnings. They all talked about the fact that demand is outstripping supply to the tune, perhaps not Meta, because it's harder to measure advertising, but it looked like it certainly was being monetized in the form of accelerated cloud revenue, and in the case of Alphabet, more users on Gemini, et cetera. So I think there was some very good news in the earnings last week, and companies like Alphabet and Amazon responded in kind. So I think we have to look at looking forward as CapEx will continue to get spent. There's no question that these large hyperscalers are going to want to continue to build the infrastructure, and that means there will be some overcapacity at some point. Not everything will deliver its return on capital. Not everything will reach its monetization benefits. But we're beginning to think you've got to skate to where the puck is going. And what I mean by that is the application, the foundation, the infrastructure layer has been a source of the ebullience. We want to look now at the users of that infrastructure, the beneficiaries of the infrastructure, and the companies across both consumer and enterprise applications that embed that in their business and get the benefits from a productivity or efficiency perspective. And we don't think that's priced in.
Nancy, I want to ask you about a specific company in particular, and that is Nvdia, which is reporting on November 19th. So that's another catalyst for us to watch in the market. And we've got some headlines about its ability to sell chips into China, the information reporting that it's not necessarily going to be able to sell chips into China. So there's this kind of back and forth on that. But how are you thinking about Nvdia as one of the real cruxes of this whole trade?
I mean, at the moment, and we invest in managers, our active managers have either reduced or have brought down the Nvidia weights. I just put that out there by way of, sort of some things maybe ahead of themselves. In terms of Nvidia and what they might announce, we don't know, but what we do know on November 15th, Nvidia's talked about the fact they have sort of 14 million Blackwell chips to ship over the next 5 quarters. That has very powerful implications, I think, for this quarter earning and earnings ahead. People will continue to move their numbers higher. I mean, Jensen Huang at the big Nvidia conference talked about $500 billion backlog. And every time you hear a hyperscaler say they're going to invest more in CapEx, you have to think that plays at least near term until there's substantial competition. That really plays to the benefit of Nvidia. So look, no one has penciled in Nvidia's numbers China sales. That's just not in there. I think people are a little disappointed that Trump didn't strike a deal with China on the Blackwell chips, but it's not in Nvidia's numbers. But as I said, we want to look forward to where the puck may be going, not just the infrastructure company, but the amazing things that we think are happening and will continue to happen in the users of that infrastructure, in the application layer, et cetera. And, earlier you were talking about humanoids and robots. That's a whole nother layer of Gen AI applications still to come.
AMD trading lower along with most of the semi-complex. And more broadly here, it has been a pattern that we've seen throughout this earnings season. Tech companies beating estimates, even raising their forecasts, and the stock falls. We're seeing it again this morning with Qualcomm. So let's dig into what that reflects about the AI trade and where investors should be positioned right now. Joining me, Ivana Dilevska, Sphere Invest founder and CIO, and Sylvia Jablonski, Defiance ETF's CEO and CIO. Ivana, I want to start with you on this Qualcomm example specifically because, again, we've been seeing this playbook sort of throughout earnings season. Here, it looked like Qualcomm had a pretty good quarter and the stock is falling. So what gives here? What's your perspective?
So Sylvia, what we've seen this earnings season is that it's all about positioning. So it's really not so much about what the companies are reporting, but more about how investors were positioned going in. Specifically to Qualcomm, they announced a new data center chip a few weeks ago, so the stock was up on that going into the earnings. They didn't quite provide any additional detail on the earnings. They said that more details will be coming next year, and this is why you're not seeing an outsized positive reaction to the beat.
Sylvia, what do you think sort of more broadly here? Because it's not unusual to see this. We've seen it throughout earnings season where the numbers initially look okay, but then the stock's been falling. Does this just reflect this sort of underlying wariness about the valuation question?
Hi, Julie. I think it's a great question, and it's really a great point, right? Because earnings seasons have arguably been coming in, fantastically. Even the companies that perhaps didn't meet analyst expectations have done quite well. We're having 80% beats on the top and the bottom line. My take on this is that expectations are so high. There's a lot of talk about overvaluation, and essentially any little, deviation from the perfect report, I think is at this point going to set investors to perhaps take some gains in their positions or reduce because they're worried about this overvaluation problem and where we are. But what I would say is, when the market's rallying and these stocks are at all-time highs, which has been, every other day over the last couple of weeks, right? We hear a lot of investors saying, I have a lot of FOMO because I couldn't get in, right? And so here are the dips. And if you think AI is going to stick around and you think these companies like Qualcomm, Broadcom, Supermicro Computers, AMD, Nvdia are going to be part of AI and the build out in AI infrastructure, it's worth considering looking at these names now.
What do you think, Ivana? Do you think the sort of buying the dip approach is the way to go when you see these kinds of sell-offs?
Absolutely, Julie. And to Sylvia's point, I think we do see people overbuying the stocks, but if you look at the valuations, they're not necessarily high, and this is because we're seeing the beats. So, right, each time a company beats expectations, the multiple, if the stock doesn't positively react, the multiple goes down. So this is why the dips are really good buying opportunities, because you're not really chasing a higher multiple.
I mean, to some extent then, Ivana, I'll put this one to you first. To some extent then, do the actual details of the earnings become less important in a way? If you're buying into this whole AI thesis, and you think that a broad swath of companies is going to benefit, like how much does the quarter by quarter matter?
So quarter by quarter doesn't necessarily matter, and the earnings reactions don't matter, but the numbers are very important in the long term, right? Or even on a few quarter basis. So if the companies are not consistently beating, it's going to be almost impossible for the stocks to keep going up, right? So you really need the numbers. Now, whether they beat expectations by more or less than the buy side expected, that's going to determine the quarter reaction. But whether they're going to be up into next year, it's really going to depend on how much did they beat by on several quarter basis.
Well, I want to bring up another example here with you, Sylvia, and that's Supermicro, which you mentioned. The company reported earlier this week the stock did fall, and there, it's not just about beat or miss, right? It's about, do you see that long-term path for growth? What did these Supermicro numbers tell us, especially given the fact that they recently sort of warned, and are there any concerns there?
Well, and to piggyback off of what Ivana said, I think it's a great point to make, right? The numbers do matter because we need to justify these multiples in order to get people to want to buy them. And I think, and then, dips in that case are good if the news is good. So with Supermicro, they came out and said that there were some design issues here. If you look at the overall global sales for the semiconductor industry, it's about a quarter over quarter growth of 15.8%. And, this company was kind of down 15% quarter over quarter on their side. So I think investors, though, because it has fallen quite a bit, this is a stock that has been a performer over the last few years, and they are a pure AI play. They are a company that's arguably, going to have some leadership opportunities in data centers and edge computing and 5G, in the general AI build out. And so I think that they're kind of in the right spot, right? So it just depends on what happens now with these designed and customizable chips, what kind of opportunities they get. But historically, it has worked with this stock to buy on the dip. That being said, again, to Ivana's point, the numbers do matter, right? So with the other companies that are falling, the numbers are there. So with this, we're going to have to wait and see.
And something else that is sort of out there in the ether, another story that was reported today, has to do with M&A. And so I'm curious to ask both of your perspective on this. It's the story that Bloomberg is reporting that SoftBank had looked at Marvell technology, possibly to buy it and combine it with ARM. And Ivana, I know that Marvell's one in your portfolio, so what do you make of that story? And do you expect more consolidation to happen?
Well, Marvell has been specifically very undervalued here because they did not out-deliver on the 2 prior quarters that they reported. And with expectations being high for the AI trade, the stock has really not performed well this year, especially compared to peers. So I think it makes total sense that SoftBank would be looking at buying it here. I think long term, it's a very strong story. They're levered to Amazon. And Amazon also themselves struggled a little bit to get Trainium up and running. Now it seems like it's doing much better. So I think the fundamentals for the rest of the companies that are exposed to Amazon are getting much stronger into 26. So the fundamentals for Marvell are pretty solid.
Interesting. Okay, so whether it's a deal, whether it's things inflecting a little bit better for Amazon, Sylvia, kind of what's the next catalyst now for growth? I mean, we've got Nvdia coming up on November 19th reporting its numbers. I guess you could debate whether that's going to be a positive or negative catalyst given some of the reactions we've been seeing. But is that the next thing you're looking to? What's sort of the next thing now?
I mean, in terms of, we need the quarterly earnings calls. We need to hear what they're doing. We need to hear, particularly from Jensen Huang, because he is essentially the poster child for AI, or the stock is at least. Very much the bellwether and the market driver really this year. So it does matter. But that being said, I'm looking at, AI. The AI trade has worked incredibly well for investors in most semiconductor positions. I'm just trying to think about where is the puck going. And I think that now we're starting to have to look at the second and third derivatives of AI to really find these, kind of hyper growth opportunities potentially that can exist. And I think that looking at AI infrastructure, the energy, the AI powered infrastructure play behind just the chips and the whole, movement, it will be an interesting place for investors. Like, you just look at these energy companies, you mentioned it at the start of the segment, they're doing quite well. And I think a lot of that is because they are powering this phenomenon here. So I'll be looking at AI powered infrastructure.
And what about you, Ivana?
I think that's spot on. Basically, we are ahead of the next wave of investments in AI, and it's specifically targeting the infrastructure side, so both physical infrastructure and and software infrastructure. So I think there is a lot of opportunities on the networking side and a lot of opportunities on the power generation side.
All right, ladies, thank you both for being here. Appreciate it. Ivana, Sylvia.
Thanks, Julie.
Thanks.
Well, tech concerns weighing on markets as investors debate whether tech valuations are just too lofty. Recently, hedge fund manager Michael Burry, who correctly predicted the subprime mortgage crisis, remember, disclosed bearish wagers on AI trade favorites Nvdia and Palantir. For a closer read on tech and options trades, we've got Tidal Financial Group YieldMax strategist Mike Coe joining us now for the Options Playbook, sponsored by Tasty Trade. Mike, it is great to see you. Interesting, Mike, maybe we'll start kind of broader here. You've been watching the markets a long time, Mike. You're a veteran, and we were just talking to Qualcomm CEO Cristiano Amon about this. A big debate right now. Maybe it's the debate, Mike, is this question of AI boom or AI bubble. And I'm curious, Mike, just to get your take on that. What do you think?
Well, I think it's definitely a boom. That's undeniable. I mean, we can just see that in the level and scale, not only of what the stocks have done, but the spend and the revenue growth that we've seen in these respective companies. I mean, the profitability, top line growth, scale, scope, margins, all of those things with names like Nvdia, we really haven't seen that kind of thing before. I mean, we're looking at better than 50% net income margins after taxes with annual growth rates that are, they were over 100% at one point. Obviously, it's slowed down a little bit since, but it's hard just because of the laws of large numbers for it to continue to grow at the pace that it was. But it is quite incredible. Now, the concern that it's a bubble, having lived through a couple, as you reference, in the tech wreck, so I'm referring now to, the period around the dot-com, late 90s, early aughts, that was a little bit different because you had companies that didn't have meaningful revenues in some cases, certainly didn't have legitimate earnings, and even those that did have very good earnings, like Cisco, which was the poster child for that era, were trading at multiples that we are not seeing today. Cisco was trading at more than 200 times earnings at its peak. Nvdia is closer to 30. So it's hard to say that it's the same kind of bubble. That said, there's obviously a great deal of enthusiasm here, and if CapEx slows, that's probably going to weigh on companies like Nvdia pretty hard. But there's no sign of that slowing, at least not through the end of 2026.
Let's get to two AI names, Mike, I want your take on. So Nvdia and Palantir making news. I'm curious, Mike, to get your take. What did you make of the Michael Burry disclosures with those names? And what are you seeing in the options markets with those names?
Yeah, I mean, these are two very busy single stocks with respect to options. I should mention we have very substantial positions in both of these, actually, probably a little over $2 billion in these two stocks combined. One thing I would point out as you look at that, first of all, when you see that huge short position, just bear in mind that that's the notional exposure if all of those options converted to stock, right? So when you look at the Palantir trade, for example, or the Nvdia trade, one of those is, I think, 10,000 contracts in the aggregate, which would represent 1 million shares. But that doesn't mean that he's actually short 200 million notionally of the stock right here. The other position is substantially larger. The Palantir position, if it all converted to stock, would be close to $900 million. But when you buy options, you're putting out a smaller amount of premium to make a bearish bet. And then if the stock falls, you have the right to sell it at the strike price. But these are very big bets for a fund of his size, it should be said. It's interesting. I don't put these two into the same category. Specifically, Palantir, even net of its sharp declines that we've seen in recent days. And I know Alex Karp was unhappy with how the stock performance was behaving basically after they reported earnings. But it's trading at 100 times revenues. That's a pretty rich multiple, no matter how you slice it. I don't think the market's treating them unfairly. There's no bear raid going on in the stock right now, but it's a rich valuation. So I can kind of see where Michael Burry's coming from on that point. On the Nvdia trade, which is smaller, the multiple is actually not outrageous given their current growth trajectory. It's actually cheap, one could argue, relative to the market. So I look at these two things differently. I think it's more of a beta play. You buy some puts. These are the high beta names. If things roll over, even if you got just a correction, forget about a bear market, just a correction, these stocks will be down more than the market overall, most likely, and those puts will probably be profitable.
All right, we're talking AI. I want your take, Mike, on another big theme, which is crypto. I'm curious just to get your sense, one, of the moves we're seeing there, and two, as I'm just looking at Bitcoin here, Mike, would you be buying here?
Yeah, so we have positions in several crypto names, it should be said. We have positions in IBIT, which is the ETF that tracks Bitcoin. We have considerable positions in MicroStrategy, which obviously is closely correlated. They've got about 640,000 Bitcoin on their balance sheet right now. I would not be buying it right now, though. Adding to it's a little bit difficult. You want to see this current period of weakness start to reverse. You want to see a bearish to bullish reversal. It's below its long-term trend line right now. There's clearly a little bit of concern. And the time to really decide that you're going to get aggressive and buy dips aggressively is when you see the flush, the absolute fear. So whether that's the broad market, the VIX is over 25, something like that, that indicates that there's that last rash of panic selling. That combined with really heavy volumes. But when something's in a steady downtrend, we call that trying to catch the falling knife when you reach out and try to buy something where the momentum is just not in your favor. And at the moment, it isn't quite yet.
Mike, always great to see you and to have you on the show. Thank you, sir.
Thank you.
Concerns, of course, have been weighing on these Palantir shares, despite the company topping third quarter estimates and raising its full year guidance. Joining me now is Gil Luria, D.A. Davidson, head of technology research. And obviously, Gil, there are two things going on here. There is the fundamental story of the company, and then there's the stock story of the company. On a fundamental basis, in these numbers, was there anything not to like?
No, the results were spectacular. They exceeded any expectations anybody could have. This is a company that's more than a $4 billion run rate, growing 63%. It's more than doubling its commercial business. And these aren't little deals. They have some customers that spend as much as 9 figures on Palantir software. So companies are lining up to use Palantir in order to achieve their AI goals. The government business grew 50%. The government's still leaning more and more on Palantir to achieve its own mission critical goals. The stock is down today. That has nothing to do with the fundamentals from last night.
Okay, so what does it have to do then? Is it just a valuation question and this was sort of a sell the news kind of situation?
More likely. I actually think it has nothing to do with Palantir. To your point earlier, this is more about a risk-off vibe today. Nothing more than that. You can see a lot of the higher multiple, more AI-exposed companies, stocks being down today. Again, I can't imagine anybody expected Palantir to do better than they did last night.
I mean, but at the same time, Palantir's price to sales are something like 85, the highest in the S&P 500. Even if this company is fantastic, does it deserve the valuation, the multiple that it has?
That's the tough question because both on the price to sales, price to earnings, EV to cash flow, there's no way to justify Palantir's valuation. It is completely divorced from fundamentals and from any other valuation of any other company, which is understandable because they're doing so much better than any other company. They are by far the best software company, but the valuation, it's hard to justify. It's hard to tie it to a cash flow, a discounted cash flow. It really is. Investors that buy Palantir are buying it because they expect the growth to continue for the foreseeable future and beyond. It's a very individual investor-based stock. And so it's very hard to argue should be trading at 80 times EV to cash flow, EV to sales, at 100 times EV to sales, at 60 times. It's very hard to argue. These are all arbitrary numbers, and hence the challenge, and hence a day like today where, again, the results couldn't have been better and the stock is down.
Well, okay, so Gil, let me ask it this way then. What is the total addressable market for a company like Palantir, and is there anyone really competing with them directly in what they do?
So there is no ceiling for Palantir anytime soon. Just to give you proportion, again, they're more than 4 billion run rate. Adobe's 20 billion run rate. Salesforce 40 billion. Oracle 50 billion. There's nothing limiting Palantir's growth. That's part of the excitement. That's part of how investors are justifying this very high multiple. And then in terms of competition, everybody's trying to do what Palantir is doing, which is help companies get to their AI goals, and nobody is succeeding as well. And it's not an accident. Palantir is an overnight success story, 20 years in the making. They do some things extraordinarily well. They help companies and government agencies collect disparate data sources, combine them so you can use AI without compromising the privacy and confidentiality of those data sources. They give companies the soup to nuts service in terms of all the software components, all the services components, instead of those companies having to cobble that together from different software companies and third-party consulting and internal IT. Those are two very unique capabilities that really nobody else is doing and are actually kind of hard to replicate. That's why Palantir is doing so much better than anybody else. And again, the sky's the limit because at their size, they can continue to grow at these rates for many years.
So, Gil, you've got a neutral rating on this stock. And is it just because of what you said earlier that it's hard to, like, it doesn't fit neatly into the financial models that folks in your business traditionally use? Is that the issue?
That is the issue. I'm just a curmudgeonly old sell-sider, and I feel like multiples matter and have to make sense and at least be anchored to other multiples for other companies or historical multiples. And as we said, with Palantir, that's not the case. The multiple is so high that it really is divorced from fundamentals. But again, great company with a great mission doing phenomenally well.
Gil, I do want to ask you more broadly about the risk-off movement that we're seeing today. As I mentioned, you had the Michael Burry filing, right, about the put options on Palantir, as well as some charts that he posted on X. Is there a bigger question to ask, and where do you stand on that bigger question of where tech valuations are right now? You've heard it all. We've talked about it before, the circularity of the spending with OpenAI at the center. How are you thinking about it right now?
There's two categories. There's the real companies that are doing real work and are actually not trading at a very high multiple. Microsoft, Amazon, Google, and Nvdia. They are building an AI infrastructure, and they all told us last week that they saw a positive inflection point in AI demand. There is increasing need for compute, and those companies are responsibly building out that compute. There's a whole other category of bad behavior, using debt to finance, very expensive debt to finance data center build out, related party transactions where you're investing in your customer and then helping them borrow even more money to buy more of your product. Both things are happening simultaneously. But again, I point out Microsoft, Nvdia, Meta, Google, Amazon, all trading at less than 30 times earnings. Those are attractive valuations for companies that have seen a positive inflection point. As you start getting into this more speculative bets, your Oracle, your CoreWeave, your Oklo, those are extraordinary. Even your AMD and Broadcom, those are extraordinarily expensive on what is much more speculative, much more reliant on the ability to raise debt capital, expensive debt capital that may or may not be available for very long. So those two things are coexisting. It's important to focus on the real companies doing the real build out based on real demand.
Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem and noisy numbers to give you the information you need to make the right trade for your portfolio. I'm your host, Allie Canal, in for Jared Blickery, and with me is Yahoo Finance senior reporter Brooke DePalma. Today, we're diving into the world of AI. AI is fueling one of Wall Street's biggest booms. Hype is sky high and money's pouring in. But is the AI wave built to last or just another bubble ready to burst? This all brings us to our phrase of the day, which is AI ecosystem. We'll explain what it is and how big names like Nvdia, Palantir, Microsoft, and Meta all play into the fold. And on today's Market Show and Tell, we're breaking down all you need to know about PE ratios. And as Nvdia continues to set the pace in AI, we'll also break down its current and forward ratios alongside Palantir to see what these numbers reveal and where tech and investors are headed next. Plus, our number of the day, 3. The current bull market reached its 3-year anniversary in October, which historically suggests this milestone may be a welcome sign for investors. We'll get into more of this later on in the show, but for now, joining us now to discuss is Hennigan & Walsh Chief Investment Officer and friend of the pod, Kevin Mon. Kevin, welcome back to the show.
Great to be here.
And great week to have you because we've seen a lot of volatility this week, particularly in tech. As you zoom out, look at where we've been this entire year, where we're possibly heading. What's your bird's eye view?
Boy, if every investor isn't asking me that question this week already, we're only on Wednesday, right?
Yeah.
But if you think about how far we've come in the markets already this year, coming into the week, the S&P 500 was up over 17.5%. We had 37 record closes thus far this year, on top of 57 record closes for the stock market last year. We have the market trading at enhanced or elevated valuations, talking about PE, which we'll touch upon later in the show. So that's led a lot of people to question, how much longer can this bull market run? Where can we find growth opportunities? Will there be some more volatility in the near to not distant future? All of that I'm happy to discuss with you here today.
But we are hearing from some executives, including Morgan Stanley CEO, that maybe we'll see a 10% to 12% pullback in the next few, say, 12 months for this market. What do you make of those sort of suggestions? And do you think that that would be sort of a healthy correction?
That's a pretty long-dated forecast. I heard that they're calling for a pullback or a correction over the next 1 to 2 years. 2 years? My investors are asking me, what can we do to invest and find opportunities for growth and income in the fourth quarter as we position to turn the calendar into 2026. Do I think there's going to be a pullback? I certainly do. In fact, I think there'll be more short-term bouts of volatility over the course of fourth quarter. But each bout of volatility is going to be greeted by more cash coming off the sidelines and unfortunately likely running into the areas of the market that are really overvalued right now. Those large cap tech plays, because investors, as they typically do, try and chase returns. And I think there's better opportunities for growth for these investors to consider. And I think they'd be wise to build more of a diversified framework, looking to the entire AI ecosystem as opposed to just trying to pick 1 or 2 names.
Let's dive right into that because our phrase of the day is AI ecosystem. When we talk about AI ecosystem, we mean everything that makes artificial intelligence possible, from the chips that power it to the cloud systems that run it to the software that brings it all to life. So Kevin, you mentioned to us, given the opportunity that let's say that you do a 3-hour show, you'd be talking about this AI ecosystem, but we only have about 23 minutes here.
All right,
so for
I'll squeeze it all in.
just starting to dive into this world of AI, where would you suggest that they even begin?
Yeah, so when I travel the country, the number one question I get from investors is, can you find us the next Nvdia?
Oh, boy.
And I think that really does the entire AI revolution a disservice. Look, I consider Nvdia to be at the hub of the overall AI ecosystem, and I think their tentacles will continue to spread into all facets of our economy and society. But that doesn't mean it's the only investment opportunity. For example, did you know that Nvdia doesn't make their own chips? The largest seller of chips in the world doesn't make their own chips. Taiwan Semiconductor does, the largest dedicated chip foundry in the world with nearly a 60% market share. But even Taiwan Semiconductor doesn't do their own lithography. That's outsourced to ASML. ASML's largest client is Taiwan Semiconductor. Taiwan Semiconductor's largest client is Nvdia. Nvidia's largest client right now is Alphabet. But all of these chips need to go into a server farm, which resides in a data center. Those data centers run hot, so they need cooling solutions from the likes of Vertiv or Modine Manufacturing, right? And then, of course, you need the power. These data centers can't manufacture their own power, at least as it stands right now, so they often have to turn to the utilities of the states that they operate within, whether it's for natural gas or nuclear power. It's all part of the overall ecosystem. So when you look at it under that lens, all of a sudden there's abundance of investment opportunities beyond just Nvidia.
So you're just talking about the ripple effect of AI, and you were also alluding to the circular investments that we're seeing among some of these big players. And that's led to more questions about whether or not we're in a market bubble, whether or not valuations are too frothy. And that's been mentioned as one of the reasons why we've seen volatility over the past 2 days. So when you look at the bubble question, how do you frame that to clients, and what are your overall thoughts there?
Yeah, I would suggest to clients or anyone who asks me this question, including you right now, Allie, if you're waiting for the AI bubble to burst, I think you're going to spend a long time waiting and likely miss out on some significant returns while you're waiting. Now, that doesn't mean that there aren't some lofty valuations within certain companies within the overall AI ecosystem. But I still contend, if I could use a baseball analogy on the show right now,
of course.
right? I contend that
we're lost. Dodgers won.
Go Yankees. That we're only in batting practice. And this is a double header. Batting practice involves all the AI infrastructure build-outs. In fact, Jensen Huang has suggested by the end of this decade, there could be the $3 to $4 trillion in AI infrastructure investment. We're not even at $1 billion right now by the end of this decade. Wow. And we haven't even moved into the games right now. So if you think about the companies spending tremendous amount of CapEx dollars on AI infrastructure right now, their ROI may not come for years to come, right? But the bigger risk to me is not those companies who overspend, it's those companies who are underspending or not spending at all, because it's going to be very hard to play catch up with all these strategic alliances are now taking place. It seems like, the show Survivor. Everyone's trying to form strategic partnerships to make sure they don't get voted off the AI island. And that's what we're seeing take place.
We have baseball, we have Survivor.
Oh, I got analogies.
But this all contributes to valuation, which means it's now time for Market Show and Tell. And today we're talking about PE ratios. Two companies generating tons of buzz have been Nvdia and Palantir. But how do their current PE ratios compare to their historical averages? And what does that suggest about how the market views their future growth potential? So Kevin, what do they suggest about where valuations stand today, where they're going, especially when we look back at historical norms?
Sure. So if we look at just the market as a whole right now the S&P 500 is trading at about 23 times current earnings. Doesn't seem too excessive, but it is above its 5 and 10-year average. If you look at forward Ps, that's actually a little, I swapped that around. Forward Ps are trading around 23 times right now. Current P is nearly 28 times. Now you look at Nvdia. Nvdia, last I checked using Morningstar data, was trading at about 31 to 32 times forward earnings. Fairly reasonable in relation to the market, right? Above 10-year averages, but still reasonable compared to the market, especially with our growth potential. Palantir, on the other hand, you can't make that same argument. They're trading over 200 times forward earnings and over 400 times current earnings. I believe in Palantir's story. I think it's a good company with a tremendous amount of growth potential, but the stock price, on the other hand, seems to be priced to perfection and trading a little bit rich right here.
Well, to remind our viewers, what exactly is the average PE ratio that they should be looking for in this environment?
So I always go back to the market as a whole. So if you look at where the market is trading right now, with a current PE of around 27 and a forward PE of around 23, even though that's above their 5 and 10-year averages, both of those figures, I think if you look at a forward PE in that low 20s range, that suggests to me a reasonable valuation. If you can get below that, that's even more attractive. That's where value-oriented investors look. If you want to get some growthier names, then you're getting into the 30 range, but not 200 or 400 times earnings.
And we just saw Michael Burry take out short bets against Nvdia, against Palantir. And you'd have to think part of his reasoning is due to valuations and the frothiness. So what are your thoughts there when you look ahead to the future of AI? You were talking in the break but before we went about how the AI revolution is not dead at all.
Not at all.
So I guess as an investor, how do you really digest all the different headlines and anticipate what's to come without falling behind?
Yeah, I think what you need to look at and appreciate is where we are within the overall AI revolution and how transformative it will be. But whether you're an investor in AI companies or a company investing in AI, you have to be patient. because your returns on investment may not come in the very near future. But if you try and play catch up, if you're trying to time the bursting of the AI bubble, you're likely to miss out on significant returns. And if you're waiting to invest in building your own AI factories, your competitors may race by you. So you have to keep it in its proper perspective. The gentleman who was putting shorts on those two companies, I think they're two very different companies. And I don't know if he's actually betting against the success of these two companies. It's a valuation concern from him. He thinks they're going to have to trade down. Palantir and Nvdia are very different, though. If you look at Nvdia at the hub of the AI ecosystem, where they're trading from a forward PE perspective, and the fact as well that 88% of their revenues last quarter didn't come from chips, but came from data centers. So now they're diversifying their revenue base. I think they're two very different stories. We own both of the names within Smart Trust in our AI-oriented portfolios, but I think they're two very different names right now based on valuations and based on what they do and the roles they play in the AI ecosystem.
Yeah, and I think it's worth noting that Michael Burry was the hedge fund manager that called out the 2007 housing crisis.
Yeah.
And that's really why it got so much attention on Tuesday afternoon or Tuesday morning. Just really quickly on this AI, some people doubt that it's actually going to end up coming to fruition. Quickly, what do you say to those doubters?
I would say look to the recent announced partnership between Eli Lilly and Nvdia. They formed a strategic partnership to build AI factories and supercomputers for drug discovery and drug development. Talk about using AI for good. It's coming, and it's going to be transformative in different areas of society, but most notably healthcare.
We have a lot more to discuss, but for now, we need to take a short break. Coming up, we're looking at the future of our current bull market and whether or not those record highs have the legs to keep climbing higher. Stay tuned. Welcome back to Stocks in Translation. Our number of the day is 3. The current bull market just hit its 3-year anniversary in October. And get this, according to research from Creative Planning, the last 5 bull markets that made it to year 3 all kept going. The shortest lasted 5 years, and on average, they ran for 8. Of course, past performance isn't a guarantee of what's next, but it does give investors reason to feel a little more optimistic about where markets could be headed. So, Kevin, what are your thoughts on this, and how does it feed into your outlook for the rest of the year and into 2026?
It gives me another reason for optimism, right? I do think there are multiple tailwinds supporting the equity markets right now. One, earnings growth. Right now, we're tracking at about a 10.7% year-over-year earnings growth rate. If that holds, that would mark the 4th consecutive quarter of double-digit earnings growth. I think the AI revolution is alive and well. I think even though Chair Powell sounded slightly more hawkish at his last meeting, they're more dovish, and we'll see short-term interest rates come down over time, maybe not as quickly as some would hope. And I also know, looking at history, that there are better days ahead. And of course, you're right to point out past performance isn't indicative of future results. This time could be different. But if the average duration for a bull market that gets its 3-year anniversary is another 5 years, wow, we have a lot more growth potential ahead. But I don't think all of that growth is necessarily going to come where it was over the first 3 years. We're now going to need to see the breadth expand, go beyond growth into value. Look at healthcare, look at biotech, look at aerospace and defense, look at some areas of the fixed income market. You're not going to be able to just throw a dart at the AI dartboard right now and find the next hot semiconductor name. Everyone's there already. You're going to have to look to other areas for growth, and investors would be wise to consider different areas without abandoning, of course, the AI names.
In pharmaceutical, healthcare, those are some companies that have not performed well over the past year, especially when given tariffs and the certain environment that we're seeing. What do you think is the momentum that's happening right now within that sector?
Sure. So we saw in the month of October, healthcare was actually the 2nd best performing sector behind only information technology. But I don't know if large cap pharma was necessarily leading the way there. I think small cap biotech was also contributing to that performance. And that's where I see the investment opportunity. Because large cap pharmaceuticals continue to be pressured by Congress, and perhaps rightly so, to lower drug prices. They also have several of their large revenue producing drugs coming off a patent or scheduled to come off patent and be subject to generic pricing. And most of these large pharmaceutical companies don't have their own R&D divisions anymore. They sold them off. Takes too long. It's too litigious. It's too costly, right? So where are they going to turn to replace all this lost revenue potential? they're going to have to be acquisitive, and they're going to acquire the innovative healthcare solutions that these small cap biotech companies are trying to get across the FDA finish line, whether it's areas such as obesity, gene editing, gene splicing, CAR T technology, oncology treatments. That's where they're going to focus in on. So that's where I see the opportunities for growth in healthcare.
So a lot of what you're talking about when we look at market breadth is the concentration risks that's in this market. I mean, we have 30-something record highs for the S&P, and that's driven by the top 6 performers. And it's been that way for a bit of time. And when I look at pullbacks like we saw on Tuesday, it points to how fragile this market is. And when we want to climb out of that, the market breadth, it just feels like it's not there at this point. So when we talk about the sustainability of the bull market, the sustainability of market rallies moving ahead, how does the market breadth story fit into this for the other 493?
It's really important because as portfolio man, look, I've been doing this for over 30 years, right? So I come on to your show and I say we need market breadth to expand for the sustainability of this bull market run. But we don't need to expand at the expense of the technology sector, right? The technology sector accounts for over a third of the weight of the indexes right now. And almost every retail investor has exposure to the information technology sector, either directly or indirectly through their 401k plan. So it affects investor psyche, and it also affects actual index level performance. But for this to continue, we do need it to expand into areas such as healthcare. And that doesn't necessarily mean I'm forecasting the economy to slow, because healthcare is traditionally a defensive sector. Consumer staples. I love the utility sector right now. Very defensive sector. They pay good dividends, but they've also become a backdoor play into the AI revolution. So now you can play defensive and AI both at the same time. So there are different ways that you can navigate this type of environment by considering different sectors.
And a quick follow-up to that, is AI fundamentally changing the rules of the game when it comes to how markets work? You were just talking about utilities. It's not just a defensive sector anymore. So how does that change how people will invest moving forward?
It's a phenomenal question. So I gave the example about a year and a half ago of a company that was leading in terms of performance in our own AI ecosystem portfolio, outperforming Nvdia. So everyone's like, what is it, AMD? Is it Broadcom? No, it's in the industrial sector. The industrial sector, what the heck does that have to do with the AI ecosystem? Well, as I said earlier, data centers run hot, and they need cooling solutions. So this company that we found is a traditional HVAC company who supply cooling solutions to warehouses and distribution centers, which have now become data centers. The company was Vertiv. And now everyone's talking about Vertiv and looking for other Vertiv-like companies, like Modine Manufacturing, Comfort Systems, or even Trane Technologies. So that's just another example of ancillary benefactors of everything that's taking place within the AI revolution. And it really is changing the rules, as you say, for areas to find potential growth, but still be cognizant of valuations. Chasing a company that's trading at 400 times current earnings might be a little rich, regardless of how much they're going to take over the world over time.
And as we talk about this bull market and the extension that it could have in this run, like if for investors who are just looking to get in and maybe they have a 5-10 year, what exactly should their timeline look like for these investments to ultimately play out in this environment?
Sure. And I always encourage investors to stay true to their risk tolerance. In other words, if the market is moving higher, that doesn't mean you get more aggressive. Just as much as if the market's moving lower, you don't get less aggressive or try to flee to the sidelines. Again, I've been doing this for multiple decades. I'm not going to tell you my age, because multiple decades. And I can't time the market, right? Because you got to get it right twice, when to get out of the market and when to get back into the market. It's when to get back into the market that's often most difficult. And here's another stat that you could use on your next show as well. But we looked at the research, and through 2024, over a 20-year time frame, 7 of the 10 best days in the market over the last 20 years came within 2 weeks of the 10 worst days. Now, I don't know when those 10 worst days are going to be. I don't have a crystal ball. But I do know if you're not in the market on those 7 of the 10 best days, you're likely to miss out on the most significant returns the market has to offer.
Well, look what happened February. DeepSeek,
Great
April,
example.
Liberation Day tariff flows, and look where we are now with the record highs that we've seen. I also want to talk a little bit of the Fed, right? Because for a lot of these companies that are not the Mag 7 players, what the Fed does greatly influences them when it comes to borrowing costs. What's our outlook for the Fed, especially since we've gotten a bit more hawkish commentary about that December rate cut?
Yes. The only way I would suggest saying that differently. I think they become a little less dovish
Right.
following those comments. Because if we go back to September, prior to the government shutting down, we stopped getting updated economic data releases. They forecasted at that time unemployment to rise to 4.5%, higher than it is right now, economic growth to slow to 1.6%. Atlanta GDP now just showed third quarter GDP at 3.9 to 1.6. What does the Fed know? We don't know right now. And at that time, they were forecasting 3 rate cuts for the balance of the year. So far, we've gotten 2. We got a pretty good jobs report today, at least above expectations.
Private payrolls, ADP.
Right, from ADP.
Yes, exactly right. But I don't think we've seen enough that would deviate them from their course of 3 rate cuts this year. We know their neutral rate is 3%. Right now, it's between 3.75% and 4%. I think we start 2026 at 3.5% to 3.75%. Of course, if they do open up the government again and we start getting some blockbuster inflation reports, I'm going to revise that forecast. But I still think there's a potential for one more rate cut this year. And that's important to smaller cap companies who rely upon that funding to help keep their businesses going, particularly small cap biotech companies where interest rates impact their borrowing costs.
And we are now in the longest government shutdown that we've ever had in history. How significant is this for the companies that maybe not only are you investing in, but just in general? How are you thinking about this, especially given that we likely won't see some new data for a while?
I think it's going to have an impact on Q4 earnings and Q4 economic growth, right? Because the longer and longer this lasts, the more it limits the amount of disposable income that could be spent out in the economy, and that's going to have an impact on both sales and earnings of companies. If, in fact, we as a society, 70% of economic growth in the U.S. comes from consumer spending. If we spend less over the course of the fourth quarter, the economy is going to slow. Perhaps that was part of the Fed's calculus in terms of lowering their forecast for real GDP growth this year. Now, as I understand it, maybe the government opens up next week and maybe you have all this pent-up optimism. We're going into the holiday shopping season. Perhaps it'll be strong and that will outweigh that. But it's becoming a concern now for economic growth, but not necessarily for the stock market. The stock market seems more focused right now on earnings and the AI potential bubble than they are about what the Fed does or doesn't do next or the government shutdown.
Yeah, well, just to recap, we learned quite a lot today. We talked about the AI revolution, the difference in PE ratios, looking at Nvdia versus Palantir, and also how necessary it is for the markets to continue to expand beyond just those mega cap companies that are leading stocks higher, aka market breadth. And then, of course, ended on a little Fed projection of where we think interest rates could be heading. And Kevin here thinks we could see one more rate cut before the end of the year. So we will have to check back in with him to see if his prediction is right. But for now, we are winding things down here at Stocks in Translation, but make sure you check out other episodes of our video podcast on the Yahoo Finance site and mobile app.